Welcome to another episode of Quest for Twice. Today is March 26th. The earnings season has ended, so today I'm going to provide a recap on the earnings from the several companies in my portfolio. The first one is Accor. Accor had a fairly solid first fiscal quarter, which ended on December 31st of 2023. So for its electrical segment, its revenue was $594 million with 34.4% EBITDA margin. That's a decline about 10% in terms of revenue from 1 year ago, also with about 4.5 percentage points decline in EBITDA margin. Its mechanical segment increased its revenue slightly from 195 million 1 year ago to 205 in the most recent quarter. However, its EBITDA margin declined by about 4 percentage points. So in total, its sales came in around $800 million compared to $834 million 1 year ago. And its EBITDA came in at 214 million compared to 264 million 1 year ago. The performance was largely driven by price decline by about 15.5%, which was largely offset by volume up. So its overall business performance wasn't much worse. Also impacted its performance was about $7 million of startup cost related to its torque tube in its mechanical segment. In that segment, its volume growth was 2.5 times its price decline. So for second fiscal quarter, the management gave a guidance about EBITDA $205 million. So that's a slight reduction from first fiscal quarter. So the price normalization is running its course, but Accor is increasing its production volume to offset the price impact. So with the volume growth after the price normalization, I see there is a pathway to long-term EBITDA of $250 million per quarter as a steady state. For the full year, the management gave an EBITDA outlook of $900 to $950 million. So that implies about $250 million per quarter in the second half of this fiscal year. In terms of CFFO, first quarter had $158 million. The company spent $44 million on capex, $96 million on buybacks, and $23 million in January. So the cash on hand was $381 million compared to debt $763 million. The company started paying dividend of $0.32 per share. So overall, fairly solid business performance. In terms of valuation, at $180 per share, its market cap is $6.6 billion, giving it an enterprise value of $7.1 billion. And using $1 billion sustainable EBITDA, we get a EV over EBITDA of 7.1. Keep in mind the torque tube, HDPE, and the regional service center investment will drive growth beyond this year. And there are multiple secular trends, including charging networks, broadband, solar power, and data center build-out that will drive future business growth. So EV over EBITDA of 7.1 is not expensive at all. Another way to look at it is PE ratio, about 10, using next year's estimate EPS of $18, which may even be conservative. So its free cash flow will be about $500 million each year. Then that tells me my original investment case still stands. Mercado Libre also reported the earnings. So we can see in the chart on the top right, all its business segments grew steadily. Most notable is the commerce product sales, i.e. 1P, that grew significantly more and faster compared to 3P. Also, its credit revenue continued to grow after being stagnant in the second half of 2022. Notably, its gross margin in fourth quarter last year dipped, mostly because of higher first-party sales and one-time tax-related issues. So it's not something to warrant a lot of worries. So for fintech segment, its fourth quarter sales were about $1.8 billion. That's driven by fast payment volume growth, as well as steady credit growth. Its credit portfolio was over $3.5 billion at the end of fourth quarter, compared to about $2.9 billion 1 year ago. But its margin didn't suffer. Its net interest margin after losses, NIMAL, came in at 39.8%. That almost recovered to the high of 39% reached 1 year ago. At $1,570 per share, its price over sales is about 5.7. So that's fairly reasonable considering there is a lot of growth in front of it. Its advertisement revenue was $215 million in the fourth quarter last year. Continue to grow both year on year and Q on Q. Overall, very healthy business. Now let's take a look at Google. So in the fourth quarter, Google's cloud revenue grew 26%. That's a pickup from 22% in the third quarter. Its services segment grew revenue by 12%. That's faster than previous quarters. And its operating margin stabilized around 35%. So look at the valuations at $143 per share. Its enterprise value over ops income has reverted to mean. Now let's look at Amazon. Its sales grew 14% from 1 year ago in the most recent quarter. That's also an acceleration from previous quarters. AWS grew 13%, slight pickup from previous quarters. The ads segment was a bright spot with a 26% constant currency growth. Its 1P and 3P sales were up 8% and 19%. On the margin side, its cost of goods increased slightly from third quarter, but fulfillment cost as a revenue has declined to almost 15%. As a result, the ops margin was 7.8% versus 1.8% 1 year ago, and that was helped by those cost reductions. Especially technology and marketing costs were up 9% and 0% year-on-year. AWS ops margin back to norm of 30%. And for Meta Platforms, its fourth quarter sales were up 25%. That was very strong. And ops margin was 41% versus 20% 1 year ago. That's mostly because of marketing costs down 29%, and the year-on-year R&D expense was only up 7%, was slower than the growth in revenue. Equifax also had a solid fourth quarter. Its revenue was up 8% on constant currency basis. Its organic non-mortgage revenue was up 9%. 2023 was characterized by mortgage headwind, with 34% fewer mortgage increase. The management assumed another 16% decline in 2024. However, without the headwind, the management also gave a guidance of revenue growth in 2024 from 2023. That's because the mortgage segment has shrunk to a relatively small base, so that more headwind does not impact overall revenue that significantly. The fourth quarter 23 EBITDA margin was 33.7%. Management gave a guidance of a 29% EBITDA margin in the first quarter of 2024. Now let's look at the growth drivers. The cloud transformation is almost done for North America, and new products and innovations has a vitality index of 15% and 14% in the third quarter and the fourth quarter last year. The workforce solutions had some headwind from hiring freeze, but still growing records as shown in the figure on the top right. M&A front with BVS closed in the third quarter of 2023. We're going to see non-organic growth impact in the first and second quarter of this year. So at $260 per share, it's an enterprise value of 37.6 billion. And so give us of EV over EBITDA about 19.8, which is a little pricey. However, we have to keep in mind that the mortgage business has a very high margin, about 65%, and that is currently depressed. So when the mortgage business comes back, its EBITDA will explode to the upside. In 2023, the mortgage segment is only 19% of its total revenue. So the mortgage business will become a tailwind with outperformance against the stable market. Now let's take a look at Walker Dunlop. In fourth quarter last year, transaction volume increased from third quarter, but still at a decline compared to 1 year ago for its capital market segment. So the segment EBITDA was slightly negative because fourth quarter was another quarter its personnel cost is greater than the revenue exclude the MSR for this capital market segment. So for the full year, its segment EBITDA was minus $46 million compared to $36 million and $85 million in the previous 2 years. So if rate stabilizes, transaction volume should rebound, and that will help this segment to have a positive EBITDA again. For its service and asset management segment, the performance was fairly stable, with revenue about $140 million in fourth quarter. So the full year run rate EBITDA is a little over $450 million, and the corporate annual EBITDA was negative $110 million. At the $90 per share, its EV over EBITDA is about 11.6 using 2022 EBITDA. For 2024, the management gave an outlook of EBITDA decline by about 8% from 2023. Now let's take a look at the Energy Transfer. The most important update for Energy Transfer is management's guidance for 2024. So for this year, the guided EBITDA is about 14.6 billion at the midpoint, with the net debt about 51.4 billion because of the recent acquisition of Crestwood Energy Equity Partners at $50.7 per unit. Its market cap is $52.8 billion. That gives a EV over EBITDA about 7.1. I calculated for 2024, its DCF will be about $8.2 billion compared to $7.6 billion in 2023. And this year, the capex will be about $2.5 billion, and the forward dividend about $4 billion. So together, that's $6.5 billion against a DCF of 8.2. So there will still be $1.7 billion of money left after paying dividend and growth capex, which can be used to buy back units if the management so chooses. So the price over DCF is about 5.6. I consider that as an attractive valuation level. Lastly, let's look at the Illumina. So in the fourth quarter of 2023, its gross margin dipped back down below 61%. That's because of the transition and the fewer consumable sales related to the older equipment, the Novasec 6000. So the key is it's a new generation of high throughput equipment, Novasec X. So as of December 31st, 2023, the company had a backlog of 38 equipment and shipped 352 in 2023. Cross-sport from low throughput to mid throughput to high throughput, the average pull-through declined. That's because of the new chemistry rollout and the hesitation from the labs to order old consumables with the older chemistry. So hopefully that will turn around in 2024. So its EV over gross income was 8.7 at $140 per share. So basically, we may be able to buy a growth company with a good valuation and get grill for free. The key is if the growth will resume once Novasec X has been rolled out and the new chemistry has been rolled out. We should get some clarity in 2024. Until next time, happy investing.